global tensions have become an increasingly significant factor in shaping financial markets. From geopolitical conflicts and trade disputes to political instability and sanctions, events around the world can directly and indirectly impact U.S. investment portfolios. Understanding these risks is essential for investors seeking to protect their assets and take advantage of potential opportunities in uncertain times. One of the primary ways global tensions affect investments is through market volatility. Stock markets often react sharply to international events, causing sudden swings in prices across sectors. Companies with global exposure, especially multinational corporations, can experience rapid changes in revenue and profitability depending on how tensions disrupt trade, supply chains, or international operations. Currency fluctuations are another critical impact. Global conflicts or economic instability can lead to sudden shifts in currency values. For U.S. investors with international holdings, changes in exchange rates can amplify losses or gains. Even domestic portfolios can be affected indirectly as stronger or weaker dollar valuations influence earnings of U.S.-based companies with international sales. Trade disruptions caused by tariffs, sanctions, or embargoes can also affect investment portfolios. Industries heavily reliant on imports or exports may see profit margins squeezed, and companies could face increased costs for raw materials or supply chain delays. Investors need to evaluate which sectors are most vulnerable to international trade risks and adjust allocations accordingly. Commodities like oil, gas, and precious metals are particularly sensitive to geopolitical tensions. Conflicts in major production regions can cause prices to spike, affecting energy companies, transportation costs, and inflation expectations. Conversely, safe haven assets such as gold often see increased demand, providing opportunities for portfolio diversification. Global tensions can also influence interest rates and monetary policy. Central banks may respond to economic uncertainty with rate adjustments or liquidity measures. These changes impact bond yields, borrowing costs, and equity valuations. Investors who monitor policy responses can better anticipate market movements and protect their portfolios. Political instability in emerging markets presents additional risks. Investments in these regions, such as equities, bonds, or mutual funds, can experience heightened volatility when governments face unrest, regulatory changes, or capital controls. Diversifying across countries and regions can help mitigate this exposure. Cybersecurity threats are increasingly linked to global tensions. State-sponsored attacks or geopolitical conflicts can target financial institutions, corporations, or critical infrastructure, potentially disrupting markets. Investors should be aware of companies' cybersecurity resilience when evaluating potential holdings. Defense and security-related industries often experience shifts during periods of global tension. Companies involved in military equipment, cybersecurity, or national security services may see increased government contracts and revenue, making them potential opportunities for strategic investment. Conversely, industries reliant on stable international conditions, such as travel, tourism, and luxury goods, can face challenges. Investors must carefully assess sector sensitivity to geopolitical risks to avoid concentrated losses during periods of heightened tension. Global tensions also affect investor sentiment. Fear and uncertainty can lead to broad market sell-offs, even if the underlying fundamentals of companies remain strong. Diversification and hedging strategies remain essential for managing these risks. In conclusion, global tensions present both risks and opportunities for U.S. investment portfolios. By understanding the potential impacts of market volatility, currency fluctuations, trade disruptions, and sector sensitivity, investors can implement strategies to protect assets, capture opportunities, and navigate uncertainty.